And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. I'm Mike Harrison, and as always, we're working on your financial freedom. If you'd like to learn more about investing in multifamily apartment communities, what that looks like top to bottom, this show is for you. This is actually a part 2 of a show I did last week. If you're just now catching this show, you may want to go back and pick that one up. But essentially, we're going through the anatomy of multifamily investing. What are all the parts of that? What are all the pieces? Last week I went through the structure of the deal, who's involved in the deal, what their roles are, the types of deals, deal size, and lifespan. And again, if you missed that show, you can go back and find us on the podcast app. Just subscribe to the Lifestyles Unlimited Real Estate Investor Radio Show. Look for that show there. You can find us at the Lifestyles Unlimited website. Click on the radio button or the podcast button. Scroll all the way down to the bottom. Type in Mike Harrison, and my shows will pop up, and you can go back and catch that part 1 of essentially the anatomy of a multifamily deal, what it looks like, what investing within a multifamily property, what are all the pieces? What does this look like? How's this all come together? And I share that because I'm an investor in many apartment communities, thousands of doors of real estate. It was something that I began 5 years ago in literally January of 2018. I made that pivot from houses to multifamily investing. I still own a few houses, but I made that pivot, and it's been great. Being a passive investor in a multifamily apartment community is awesome. I mean, literally, our only obligation is when we subscribe and we tell that lead investor, yes, we want to be part of the plan, and then that lead investor agrees to accept us in the deal. Our only obligation, and it's a serious obligation, is we said that we're going to go in the deal at a certain amount financially, and when the time to pay up and invest in that deal comes, you need to do that. So before you can subscribe, those funds, you need to have those funds set aside somewhere where you can access them quickly and wire those funds to the lead investor. You don't subscribe to, you don't go, yeah, that looks like a great deal. I'll subscribe for $50,000. Thinking that you're about to get 50 because maybe you're coming into some money, or maybe something's being sold, whatever. Don't subscribe if you don't have the funds. And quite frankly, there's a lot of deals that come across my desk, and I go, God, I'd love to be part of that one. I'd love to be a part of that one. I'd love to be a part of that one. But I just don't have the money at the time, so I don't subscribe. I may have 2 or 3 multifamily properties that are in the process of being sold, and I know that there's going to be funds coming my way after the sale of that property. However, I'm not gambling and saying, oh, I'll have these funds within 3 weeks or 4 weeks or 5 weeks, so I'm going to go ahead and subscribe to this deal now because that lead probably won't need the money for 3 weeks, 5 weeks, 7 weeks. Something always happens. Always. So don't lead these syndicators, these lead sponsors of these properties, don't lead them astray. They're counting on your funds, okay? So I hope I made our obligation as a passive investor very clear. I wanted to revisit that because occasionally you'll hear that, and there's nothing more frustrating than a lead. They're ready to close on a property, and they come back and they send a little email out, hey, dear passive investors, if you previously passed on this property and you have the ability to invest, I have 2 slots open, and typically the slots are open because people that said they could invest for whatever reason could not invest at the time, and you're just causing that extra work. Look, the lead has a lot on his or her plate already, and let's not cause that extra work. But in going through the anatomy of these multifamily deals today, I am going to revisit deal size, and I'm going to revisit it in terms of lead experience, okay? I want to talk about the size of the deal, versus the experience of that lead investor. And what I'm talking about, if you missed last week's show, the lead investor, the syndicator, the general partner, we use leads really a term within Lifestyles Unlimited. So if you're not in Lifestyles Unlimited, that's the person that's going to purchase this apartment community, manage the apartment community. That's the person putting down. They don't manage it physically themselves unless it's small. They have a management company or a management team in place. They're managing the asset. But essentially, that's the person who puts together the business plan. Here's the opportunity. Here's what we like about it. But I want to talk about, apartment purchasing within the terms of that lead experience. I do want to go back and look at lifespan of a property, of an engagement, of an investment within the multifamily property, and how changing market conditions can alter that business plan and therefore change the lifespan or the time frame of that deal. It may speed it up if you see things coming on the horizon, and it may slow it down. I touched on that a little bit last week, but I didn't get to really hit it the way I wanted to. I want to talk about getting into and out of the deal, and I talked about getting into it, your main obligation, but how do you get out of it? Can you get out of it? So let's talk about some of that. I want to go into why you might be a candidate for this type of investment strategy. And again, it's a fantastic strategy. You'll love it. Being a passive there is nothing better than being a passive investor. And then most importantly, I want to talk about how the profit works. How are you going to get paid? What does that look like? What is typical? That's why we do what we do, right? We're investing in these to make a profit, to make a return. If you have any questions for me about Lifestyles Unlimited, about how to get started as a real estate investor, please send me an email. My email address is askmike@luinc.com, askmike@luinc.com. We're talking about the anatomy of a multifamily investment, who the players are, what are their roles, how is it structured, what's it look like. And before I get back into that, I do want to just touch on housing supply for a moment. I've been getting some emails from people. There's a lot of noise out there about housing supply, and I think what we're doing is we're mixing up market demand versus just that simple want, need, demand. Now, let's go back to 2008 and 2010. Essentially, that crash caused a lot of builders and a lot of people within the industry, construction labor, new construction labor, essentially caused them to leave, right? Those people went out of business or they found other vocations, all right? Now, that industry, for the most part, has come back, but what's going on today? The last 6 months have changed, and so we're seeing an increased market pressures on new construction housing, okay? So we're seeing a little bit of change there, but that demand is still there, okay? That want demand for housing is incredible. It's millions of properties, millions of units short. Now, real estate investors like myself, do we add to the housing supply? Really, that answer for the most part is no, okay? I'm not saying that we don't have some lead investors that buy a 50 unit and they have 2 units that were, or there's maybe some building on the property, some storage building or some pool building that they can't go in and rehab that and make that 2 more units, okay? That's not what I'm talking about. So now you essentially went from a 50-unit apartment community to a 52-unit apartment community. Does that happen? Yes, but let's talk about the greater side of this. Do people like me, do real estate investors, are we adding to the housing supply? And for the most part, that answer is no. We're buying a property, a distressed property that needs some attention. It needs to be fixed. It needs to be made clean and functional. It needs to be made better. And so we take a property that's down. It may not be occupied. It may be occupied, but we're fixing it. And so the housing supply is not increasing, but we're not increasing the housing supply. So that demand's still there, and even folks like myself, we're not changing that demand. What we are doing is we're making demand for real estate's local. We're creating a demand for a particular unit, for a particular property. Same goes for apartment communities. We typically play in the Class B, Class C, workforce housing. Again, we repair it and we make it better. And at the end of the day, there's really no gain on units, just the occasional here and there. But we're really not adding units to the housing supply. Now, I can actually argue that what we do in a way, because it's not adding to the supply, that demand is increasing. Okay, demand is increasing. Now, new construction, what are they doing? Are they building workforce housing? Are they building the everyday 3-2-2, 3-bedroom, 2-bath, 2-car garage, everyday new home, starter home, or just everyday home for most people? No, they're not. They're building $400,000, $500,000, $700,000, $900,000 houses. And so, again, that demand isn't going away for the everyday house. It's increasing. It is absolutely increasing. Even you get some people that they'll do the tear down, right? They go by the old house and they tear it down because maybe the neighborhood's becoming regentrified or what have you. And they tear down the 3-2-2, $150,000, $180,000, maybe $200,000 house. They scrape it, and what do they build? Well, they fill that lot up. They build a $600,000 or $700,000 or more property on that. What did they do to demand for everyday workforce housing? They increased demand because their product does not pertain to the masses. Their product is for a smaller group of potential buyers. And I get it. There's going to be more profit in building and selling a $600,000, $700,000, $800,000 house than there is in taking and rehabbing a $150,000 house or what have you, or even building a $150,000 house. I'm not telling you to go into that arena. We don't play there. We play in the everyday arena of housing. So I see no reason at all, nothing in the near term or long term that tells me that demand for clean, functional properties will decrease in any way, shape, or form. Nothing in the short term, nothing in the long term. I don't care that interest rates are going up. They are going up. It's going to tamper. It's going to mean that some people can't buy that. But that doesn't mean that the demand for that product is going away. If you have a good, sound property to rent, and it's in a good area, a good locale, it's not some crazy property out in the weeds in the middle of nowhere with some weird floor plan. If you have a 3-2-2 and it is clean and functional in a decent area, you will always have demand. You will always have residents 100% in the short term and in the long term. And I say that for those of you that are thinking about becoming real estate investors, or maybe you are and you're tapping the brakes on it. Look, if you've got that clean, functional product, best price, it's got a sound floor plan, you're going to have a line of people that are going to want to rent that from you. And if we go into some sort of deep, long recession, that demand will increase. So understand that. Now, let's get back into the anatomy of this multifamily investing. And I invest in a lot of properties as a passive. One of the sides I wanted to touch, I didn't get to finish it last week, is deal size. I don't care what the size of the deal is. I invest in both large and small communities. Both of them are unique, and they have their own advantages and disadvantages. But if I'm analyzing the deal and I like the lead investor, I'll invest it within the deal. But understand that a small deal may turn much quicker than a large deal. You can rehab and redo 8, 10, 12 units much faster than you can rehab and redo 250, 300, 350 units. Now, The pro tip that I want to provide for you is look at this lead investor and where are they as a lead investor? Is this their first or second deal? Or is this their fifth, sixth, seventh, eighth, or 10th deal? If they're just now kind of cutting their teeth and their experience is not as great as some other leads, you're going to want to match that deal. You want to see that lead with a smaller property, something they can handle.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Successful Lifestyles Unlimited member retires in 10 months.
The hardest part for me was to drop off my son, go to a job that I absolutely hated for 5 years, but know that that was a sacrifice that I needed to make, and then only be able to get to spend 2 hours with him after school before he had to go back to bed. So that's why once we started and we joined Lifestyles, we said, okay, we have a roadmap. We know what we're gonna do. And then a month later, we find out we're pregnant with baby number 2, and we're like, okay, we gotta kick it up a notch. So that's how we were able to purchase 4 different properties and replace in 10 months, replace my income in 10 months so that whenever I finished maternity leave, I didn't have to go back to work.
I think a couple weeks before baby came out is when we closed on our fourplex, and that was enough for her not to have to go back to work.
Are you ready for your roadmap to real estate retirement? Attend the online free workshop, just like Carolina did. Register at lifestylesunlimitedworkshop.com.
I'm Mike Harrison, and as always, we're working on your financial freedom. You may not know it, but there are 4 different ways to consume the content of our radio, our Lifestyles Unlimited radio network. The easiest way, the way I use most, is my podcast app on my smartphone. I subscribe and just listen to it in my free time, or if I'm driving or traveling or working in the yard or taking a walk, any of those sort of things. Obviously, the Lifestyles Unlimited website, there's decades of radio shows on that website. You can literally find a show that caters to whatever specific category within real estate investing that you're interested in or that you want to hear at that time. YouTube, we have our own YouTube channel, Lifestyles Unlimited, and then live stream us on the internet from your favorite radio show's website, anywhere in the world that you are. If you're traveling and you know the show's coming on a certain radio station at a certain time, well, go to the internet and go to their website, and there'll be a Listen Now button, and then click on Listen Now, and bingo, you can catch us. Let's say you're in the Eiffel Tower at Paris. I'm not saying maybe you should be listening to Lifestyles Unlimited that time. We do say it's not the money, it's the lifestyle. So, yeah, soak in the lifestyle. But maybe you're lounging on a beach for the 7th day in a row down in the Caribbean, and you want to pick up a little Lifestyles Unlimited, listen to it as you watch beautiful turquoise waters crashing on the beach. I like that plan a little bit better. So we left off, I was talking about deal size. I don't, whether the size of the deal financially, I'm invested in a property that's worth about $70 million. I'm a passive investor in that. And I'm also investing in some very small $2 million raises essentially by the lead. I'm invested in those as well. So really for me, it's about the strategy. It's about the lead. But I do want to tie a thought for you. If you're just starting on this path as an investor and you want to be a passive investor and you're looking at the business plan, what is the experience of that lead? They're going to share that with you. Is this their first property, second property, third, what have you? You may have a lead and this is their 20th property. Okay. We have some folks that are that experienced, but if it's a red flag for me, and I'm not saying jump out of every one of these, and there's not many like this, but a red flag for me may be a first-time investor getting a property, let's say a 40-unit property, for instance, and look into it. This lead has a reason for buying this property. Do they have the ability? Maybe they were in the apartment industry, and so this is nothing for them. But if they're first time and it's a 40-unit and it's 6 hours from where they live, that may be a red flag. That may be something that you want to pursue a little further and ask some questions or talk to some other passive investors. We want to make sure that lead has the ability to run that property according to the plan. Now, I say 40 unit because a 40 unit is small enough that there's not enough cash flow on that property to hire a manager or a maintenance employee typically. Okay, and so that means the lead is going to be the manager, and maybe the lead saying, "Look, I'm moving to this small town, and I'm going to manage the property." Okay, that's a different story. And by the way, my wife was in the apartment industry for 24 years. Here's our resume, but just look at it a little deeper and try to match the lead's experience to the business plan. Something to consider as you're going through that private placement memorandum. Now, what is the time span of these investments? Time span, how long you're giving your money and it's going into the purchase of a business, okay? It's going to be tied up for some time. The business plan will tell you, here's the plan. We plan on buying this property and holding it, and in year 3, here's our scenario for a refinance, and here's our scenario for a sale, and as investors, we will choose what makes sense at the time. Or someone may say, that's in year 5. And some other folks may say, no, we're going to do an 8 to 10 year hold. And here's why we're going to hold it for 8 to 10 years. Now, within that, okay, let's say we get into this plan today. And our plan is to get out in 3 years, 2025. And we get to 2025 and the world is different. Well, we may take a different strategy at that time, depending on the economy. I'll give you 2 examples from my own personal portfolio that have essentially changed the time frame of one of my investments. I have an apartment community that I'm invested in. Wonderful lead investor. Fantastic. Well-run property. Excellent. Everything is going according to plan. And we get to about the time frame where maybe we would normally, or at least the business plan said, we're going to consider selling it. And a large chip manufacturer has said, we're going to invest $35 billion with a B into this little community. And the apartment community is not far from where this plant is going to be, this chip manufacturing plant, this $35 billion investment. Do you think that's changing our plans as owners of this apartment community? You bet it is. We want to hold on to this. A $35 billion injection within a couple of miles of where you own a property is a good thing, okay? That property is going to continue to cash flow. You just keep it up, make it best property, best product, best price, keep superior management, keep the amenities for the residents. You're going to be just fine for the next several years on that property. Now, I had another property that I invested in last year, and the property's doing well, stabilized, everything's going great, 100% occupancy, checks were rolling in quarterly. And what happened with that property? It was a very small property, and the plan was to maybe hold it for 2 years, okay? 2.5, maybe 3 at the max. And we get into January of this year, we've got the administration, those that be, are making some decisions that are causing interest rates to really go up. They're printing money out there, so the inflation is off the chart. Consumer price index is high. Everything, all these signals are saying, hey, we're coming into a downturn. If we sell the property now, we can collect this amount of return. What do you think, passive investors? And so the lead sent that out to us. And I think to a person, we all voted. I want to say the vote was 90+% to sell the property. Yeah, let's take the money. We have an opportunity to sell it right now, and let's jump out of this deal, and we can go put that money somewhere else. Now, what else can affect a property? Let's say property taxes and insurance keep going up and up and up and up, and those are just eating into the bottom line, the cash flow of the property. At that time, you may have the lead investor say, hey, here's something that was unexpected. We had taxes and insurance at X. They're now 150% of X. We've fought them. We've tried to fight them. We're not having any success, and they're eating into the bottom line. So hence, our returns are being minimalized. Maybe we want to sell this property, but they'll throw it out there, and as a passive, we get to vote on that and decide what direction we want to take. Maybe we want to ride it out Maybe we're okay with the cash flow. Maybe we're not. But, as a group, we have the ability to vote on that property, and the lead obviously has a portion of that property, and the lead gets a vote as well. How does one get out of a deal? Let's say you committed, you're in it, and then all of a sudden you said, hey, it's been 18 months. I want out of a deal. I know that we're not going to sell this property for another 2 or 3 or 5 years, but for whatever reason, I have this situation in my life. I need out. Well, I'm telling you, you're not getting out. Most often, you're not going to get out unless the lead makes an exception for you. This is a commitment. We bought it as a group. You're in it, okay? You're in the deal. What the lead, and this will be spelled out in the private placement memorandum, how these certain circumstances in life may be covered. Today I'm going through the anatomy of a multifamily investment, who's involved, what the roles are, what some of the rules are, what do you need to know prior to getting into some of these. I'm a passive investor in numerous multifamily properties. I really enjoy investing in multifamily properties. It's exciting for me. I love seeing the business plan. I love seeing what the leads have planned for the property, the layout, everything. So I eat the whole thing up, and I'll tell you, there's nothing greater in life than being a passive investor in multifamily properties. It's really satisfying, and I began in 2018. So I've got numerous deals now. I've had several deals that have come full circle. What do I mean by full circle? Well, the whole plan is played out, right? We bought property, we improved property, we increased cash flow of property, we paid dividends, and then the time came to either refinance or sell the property. So I've gone through several of those. I've had several go full circle. Now, what kind of person or who would be a candidate to invest passively in multifamily properties? Let's think about what that would be. Typically, what we see is a work professional, maybe a high W-2 income earner, and they're very busy, so they don't have time. They don't want to buy single-family properties. They don't want to be an independent rental owner themselves. They literally just want to invest and create that passive income, and they don't want to be involved in the property. And we're not involved. That's what the lead investor does. That's what the sponsor, the deal syndicator, whatever term you want to use, those are all the same person. That's the business plan manager, right? And so a work professional may be so busy they don't want any part of it. Maybe this individual is saying, hey, I need to diversify. I've got too much in the stock market and bonds and mutual funds, and I need a different asset class. By the way, real estate is the best hedge against inflation. It's incredible. Other real estate owners with passive income, they may be saying, hey, I own this property. I'm an independent rental owner, or I'm a lead investor, and I may want to invest passively in some of these deals. So you may have some lead investors that are investing passively in numerous deals. In fact, not that you may, there are a lot of leads that are getting into other people's deals, other leads deals. They like passive income too. They like being a lead, obviously, because it's a job. But again, this is a way for them to continue to grow their real estate portfolio. I mentioned tax advantages. There is, we get what's called a K-1 when we do our taxes. And a K-1 is where you're depreciating this asset. And a lot of times our leads will use what's called cost segregation. Cost segregation. What is that? That is actually, it's the ability to speed up the depreciation. There's a lot to it. But you may have a lead deal that you're involved in. Let's say you've invested $100,000 and you earned $6,000 in 2021. They will hand you what's called a K-1, where they're depreciating that asset against your dividends, right? Against your profit, against the money that you were paid. And you may get this K-1 and look at it, and it says that you were paid $6,000, but you lost $20,000. That's what depreciation does. This is a business, so we get to tell the IRS, hey, the carpet's depreciating at this rate, and the appliances in the unit are depreciating at this rate, and we put a new roof on it and it's depreciating at this rate, and the property as a whole is depreciating at this rate. So you get to essentially write that off as a business expense, depreciate against the cash flow, and that's what makes the cash flow tax-free. Another person that may want to invest in these properties, maybe there's an individual out there and they're sitting on a ton of cash. And what's happening right now if you're sitting on a ton of cash? Well, inflation is eating you alive to the tune, at least the only numbers the government will give us are 8 or 9%, depending on what month you're looking at it. I promise you, it's way higher than that. Is gas up only 8%? No. Are groceries only up 8%? Not where I shop. I mean, they're way higher than that. So if you have a ton of cash, then yeah, you're probably going to want to put that into a tangible real estate asset so that it can grow. It can work for you. If you're sitting on cash right now, it's just getting less this year, less next year. I don't care what your statement says, that buying power is decreasing rapidly. Now, someone else that may want to invest passively in multifamily properties, I see this often, is someone who says, hey, I want to be a lead investor, but I'm not ready yet. I won't be ready for another year or 2 years. And so I want to get into 1 or 2 or 3 or 5 of these properties so that I can engage with that lead and kind of see how these unfold, kind of see what they look like, learn a lot about how to put these deals together. What would I be expected to do? How does this all look? And so they kind of put their toe in the water and say, yeah, I'll invest passively in this apartment community and that apartment community. And then I'll get, I'm now privy to the business plan. I'm privy to the monthly reports. I'm privy to the T12, which is the P&L statement, the rent rolls, everything. And so they're learning as a passive so that they can be a future syndicator, a deal sponsor, or a lead investor, as we call them here at Lifestyles Unlimited. I mentioned people, there are literally people that don't want to be bothered. They like to invest. They realize real estate's a fantastic investment, but they're not going to go buy a single-family property. They're not going to buy a small apartment community. They don't want any involvement whatsoever. That's a perfect candidate to invest passively in multifamily properties. A lot of people invest that are financially free. They're retired, financial freedom. They're busy with family and travel and their lifestyle. How fantastic is that? But they also realize they need to keep investing in these properties. You got to keep putting that money to work, grow what I call a cash flow snowball. And speaking of the cash flow snowball, what are some other people that invest passively in multifamily properties? Well, those are people looking to buy their life back one piece at a time. I'm in that deal and it pays me X. I'm in this other deal and it pays me Y. I'm in this third deal and it pays me Z. And so they're buying their life back one piece at a time, creating passive income. But again, these are folks that typically probably don't want to buy the rent property. I happen to own single family properties and I happen to invest passively. So I do a little bit of both. I like both sides of it. Now, for the best part, how do you get paid? How does the profit side of the investment work? Well, there's several different factors involved, but there's the cash flow. Okay, that's the primary. I tell people all the time, $100,000 looks like $4,000 to $6,000 in a multifamily investment. If you think of it as 4 to 6, you're going to be fine. That's what you're going to get on those quarterly dividends. Now, keep in mind, it may take a year, it may take a couple of quarters for that business, that apartment community to be stabilized before you get those distributions. But the first part is cash flow. That will be spelled out in the business plan by that lead investor. They're going to say, here's what we're buying the property for. Here's how much I have set aside for CapEx, right? Here's the improvements we're going to make to the property. Here's what the rents are. Here's what all my expenses are. And at the bottom, here's our profit, passive investor, and that will be distributed to you, and we are projecting this percent return, 4% return in year 2, 6% return in year 3. They will spell it out for you. That's their projections. That's the cash flow, okay? That's just one way that we're making money. Now, keep in mind, there may be a deep value play that might not pay you for 2 years or longer, but it's going to be spelled out in that business plan. Now, how else does somebody get paid? Okay, so it's not just the cash flow. It's not just the cash flow. Okay, there are a refinance event, right? Let's call it a refinance event. What is a refinance? A refinance is or a supplemental loan. Let's capture both of these at the same time. That's where you have a property, and let's say you bought apartment community and it's worth $10 million, and you improve the business plan, the performance, the rents come up a little bit. Everything about the property is better. And you can go to the bank 2 years later, 3 years later, and you can go, hey, bank, I know that we're in it for 30%, you're in it for 70%, but that was based on that old dilapidated $10 million property. Look at what we've done. We've put new roofing in. We've improved the parking lot. We've done the landscaping. The rents have come up $50 a month, $100 a month. It's all clean, fresh, functional. And this property's now worth $14 million, bank. And so I would like to redo our loan structure or take out a supplemental loan. And so it's another loan on the property. Now, two things are going to happen. That will decrease that cash flow, but it gives you the ability to essentially pay the passive investors back either a portion or all of their investment. Hey, passive investors, you were in for 50. Here's 100% return. Here's 50. Your original 50 is still in the deal and the property is still cash flowing. So that's one way we make money. And then also a sale when you sell the property. What does that look like? Yes, these businesses get sold. That's a capital gain. When that happens, I do set aside 20% for taxes, but rarely, if never, do I pay that full 20%. So that's what the anatomy of a multifamily property looks like. I hope everybody learned something. My name is Mike Harrison. I want you to understand it's not the money, it's the lifestyle. Make it a great day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.